The MBA Research and Curriculum Center and NOCTI have collaborated on this microcredential.
This microcredential explains financial modeling and is divided into 4 targeted skills. This targeted skill explains understanding and using balance sheets. Balance sheets are key financial statements that provide a snapshot of the company at a point in time. Balance sheets show how much money a company has and how much it owes, as well as how much is held by owners or stockholders. Balance sheets are based on the accounting equation. This equation is assets equals liabilities plus owner's equity. Assets are items that have value, such as cash, copyrights, patents, real estate, equipment, vehicles, materials, accounts, and inventory. 2 sources of assets are liabilities or debts and owner's equity or money invested in the business. Assets can be liquid or fixed. Liquid assets include cash and items that can be converted to cash. Fixed assets cannot be converted easily to cash. Fixed assets are usually intended for long-term use, such as land, vehicles, or machinery. Total assets always equal the amount of money borrowed plus the amount invested by owners and investors. These figures should always add up on the balance sheet. Balance sheets are related to other financial documents. For example, income statements record the money a company makes and spends over an accounting period, such as 1 year. Income and expenditures will change the numbers on the balance sheet. The accounting equation can be reversed to determine the owner's equity. This equation is owner's equity equals assets minus liability. The equation is based on the same figures used when determining assets. As a key financial document, balance sheets are examined on different levels. Investors review them to determine a company's value, potential for growth, and whether a company is a good investment. If a company needs a loan or credit, then the bank or vendors examine the balance sheet prior to lending money or extending credit. Internally, balance sheets are reviewed by managers and owners to spot trends and make comparisons. It is important to track company finances through assets and liabilities to be sure that assets do not decrease and liabilities are not increasing too much. Ideally, a balance sheet should show more assets than liabilities. A notes section of a balance sheet contains extra information regarding the figures. In conclusion, the 4 main components of a balance sheet are assets, liabilities, owner's equity, and notes. These numbers can change as assets or liabilities fluctuate. Together, these give the status of a business at a point in time.